November 18th, 2020, 5:43 p.m. We will talk once again about finance. I'm going to clarify some things that was not spoken in the last segment, and I'm going to correct something that correct something from the first segment or the last segment. So we, again, Department of the Treasury, Financial Crimes Enforcement Network, 31 CFR Parts 1010 and 1020, threshold for the requirement to collect, retain, and transmit information on funds, transfers, and transmittals of funds that begin or end outside the United States, and clarification of the requirement to collect, retain, and transmit information on transactions involving convertible virtual currencies and digital assets with legal tender status. So basically, they are proposing a change from the threshold of $3,000 to $250. The board of the governors of the Federal Reserve System, as well as FinCEN, the Financial Crimes Enforcement Network, they're both proposing this change. So before I go any further, there's an excellent document that I found that broke this down. It did take me a little bit of research to understand exactly what was going on with this. So finance is just one of those subjects where you have to put some time into it, but it's very important because we participate in the financial system as well as the economic system on a daily basis, and it is amazing how many people don't even understand the basics. So regardless of that, so when we're talking about money services banks, these requirements, Bank Secrecy Act of 1970, much of this is rolled up into something called the AML regime, anti-money laundering regime. In other words, they're trying to stop the illegal flow of money because, as they say, money finances terrorism, finances human trafficking, it assists in tax evasion, etc. So money service businesses must file a currency transaction report within 15 days whenever a transaction or series of transactions in currency involves more than $10,000 in either cash in or cash out, and it is conducted by or on behalf of the same person and is conducted on the same business day. So it's $10,000 cash. But what this document that the board and FinCEN have gotten together to put by way of proposal, it deals with the digital side. So another side of this, it says cash purchases of $3,000 to $10,000 inclusive. Money services banks that sell money orders or traveler's checks are required to record cash purchases involving $3,000 to $10,000 inclusive. Then you have money transfers of $3,000 or more. Money services banks that provide money transfer services must obtain and record specific information for each money transfer of $3,000 or more, regardless of the method of payment. So this specifically is what this Federal Register document from the board and FinCEN, Title 31 Code of Federal Regulations, Parts 1010 and 1020 is addressing. So instead of what they once did was record transactions, money transfers, the money services banks recording money transfers of $3,000 or more, now they're lowering it to $250 for all cross-border transactions. And I think they specifically did this for transactions involving convertible virtual currency, or CVC, V as in Victor, which is a medium of exchange such as cryptocurrency that either has an equivalent value as currency or acts as a substitute for currency, but lacks legal tender status. As we know, the US dollar has legal tender status. The agencies further propose to clarify that these rules apply to domestic and cross-border transactions involving digital assets that have legal tender status. Okay, so this is a major change, but it also puts more work on the people who work at the bank. And as I mentioned, the Federal Reserve requirement in the last segment, I came across a very succinct document that kind of explains it a little bit more in depth than I did in that short segment. Reserve requirement and how it affects interest rates, why the Fed removed the reserve requirement. The reserve requirement is the total amount of funds a bank must have on hand each night. It is a percentage of the bank's deposits. The nation's central bank sets the percentage rate. In the United States, the Federal Reserve Board of Governors, or the board, controls the reserve requirement for banks. The bank can hold a reserve either as cash in its vault or as a deposit at its local Federal Reserve Bank. That's very important. The reserve requirement applies to commercial banks, savings and loan associations, and credit unions. It also pertains to U.S. branches and agencies of foreign banks, EDGE Act corporations, and agreement corporations. So, before I go any further, let's go to the Federal Reserve themselves. March 15th, 2020 of this year, there was a press release. Federal Reserve actions to support the flow of credit to households and businesses. So they say here, the Federal Reserve is carefully monitoring credit markets and is prepared to use its full range of tools to support the flow of credit to households and businesses, and thereby promote its maximum employment and price stability goals. In addition to actions taken by the Federal Open Market Committee, FOMC, including actions taken in coordination with other central banks, the Federal Reserve Board announced a series of actions in support of these goals. These actions are summarized below. We're going to skip and go to the reserve requirement. So at the bottom of their press release, for many years, reserve requirements played a central role in the implementation of monetary policy by creating a stable demand for reserves. In January 2019, the FOMC announced its intention to implement monetary policy in an ample reserves regime. Reserve requirements do not play a significant role in this operating framework. In light of this shift to an ample reserves regime, the board has reduced reserve requirement ratios to 0% effective on March 26, the beginning of the next reserve maintenance period. This action eliminates reserve requirements for thousands of depository institutions and will help to support lending to households and businesses. Well, truth be told, the Federal Reserve is for banks, not for households. They depend on the banks to get the money to the households via loans and other financial instruments. They don't explain that. You have to dig, which I don't like the fact that they do that. So, in another press release here, as announced on March 15th, this is entitled Policy Tools. As announced on March 15, 2020, the board reduced reserve requirement ratios to 0% effective March 26, 2020. This action eliminated reserve requirements for all depository institutions. Following content explains the board's authority to impose reserve requirements and how reserve requirements were administered prior to the change of reserve requirement ratios to 0. Without me getting too deep into this, understand, okay, banks were responsible for keeping at least 10% of the money that they have on hand. Okay. So let's say the bank has, $1 million. All they would need is $100,000. Okay. So just think about that. Okay. So, the reserve requirement is the total amount of funds a bank must have on hand each night. It is a percentage of the bank's deposits. Okay. So these are two major changes. One taking place in March of this year. The other is proposed as of now. It's very interesting. So the key takeaways from this document, the one that explains it a little bit more in depth, reserve requirement and how it affects interest rates, while the Fed removed the reserve requirement. Key takeaways. The Federal Reserve requirement is the amount of money the Federal Reserve requires its member banks to store in its vaults overnight. Requiring banks to have a reserve requirement serves to protect them and their customers from a bank run. When the Fed adjusts the reserve requirement, it allows banks to charge lower interest rates, which they're not doing. They charge lower interest rates when they're lending money to each other. Banks often take on a financial burden when limits change, so the Fed often uses open market operations instead to influence banks. So a bank run is basically when a bunch of people want to run to a bank and take their money out. Well, since this requirement was lowered, the banks don't have to have 10% anymore. So the bank has $1 million. Instead of having 100,000, they can have $5. Or like I said in the last segment, it can have literally have dust on the shelves, dust in the vault. So sometimes what a bank will do is order cash from another bank. It may take them a few days to get it. They do that too, because again, they don't have to have 10% of their reserves. They don't. And now they want to reduce the threshold of $3,000 for money transfers from money services banks to $250. And they want to start monitoring cryptocurrency. Very interesting. So let's go to this document again. How it works is a section. If the bank doesn't have enough on hand to meet its reserve, it borrows from other banks. I just said that. It may also borrow from the Federal Reserve discount window. The money banks borrow or lend to each other to fulfill the reserve requirement is called federal funds. The interest they charge each other to borrow Fed funds is the Fed funds rate. All other interest rates are based on that rate. The Fed uses these tools to control liquidity in the financial system. When the Fed reduces the reserve requirement, it's exercising expansionary monetary policy. That creates more money in the banking system. When the Fed raises the reserve requirement, it's executing contractionary policy. That reduces liquidity and slows economic activity. So basically, monetary policy is about expanding or contracting the money supply. So the Fed will, when it wants to expand, it buys bonds from the banks. When it wants to contract, it sells bonds. But now, I mean, the stuff they're doing now, that's even too simplistic. It would take a whole entire series to explain all this stuff. That bottom line, the takeaway is the reserve requirement. Understand that your average bank probably doesn't have anything but dust in it. We're going full digital, people. That's where we're headed. And they're including crypto. It doesn't have legal tender status yet, but they're still going to monitor the flows of crypto, which is why your banks are involved in it now. JP Morgan with their JM coin. Okay, so in an environment like this, they're going to track transactions. Unless than $250 under the guise of trying to stop criminal money flows. And now your banks don't have any money on it because they're trying to prevent a bank run. What does that imply? That implies less cash available, essentially forcing you to use credit cards, to use debit cards, to use your crypto, whether you have a hardware wallet or you're purchasing it through Coinbase and you're selling it to get the cash out, depending upon how well the cryptocurrency is doing on the market. So we're again, that's the environment. Then you remember the coin shortage, which I sat down and logically thought about that. And I'm like, hold up. So we use dollar bills more than we use coins, but somehow we have a shortage on coins. No. Bullshit. So now lastly, let's do a little history on HSBC. And then I'll clear up the mistake that I made when I said 2019 they were caught laundering money. They were actually caught in 2012. Okay, so the Hong Kong and Shanghai Bank Corporation, that's the parent company. Okay. So it says here, the founder, Thomas Sutherland. Let's go back some. Sorry about that. Let's go here. After the British established Hong Kong as a colony in the aftermath of the First Opium War, merchants from other parts of the British Empire, now in Hong Kong, felt the need for a bank to finance the growing trade through Hong Kong and sometimes also through Shanghai, between China and British India, the rest of the British Empire and Europe, of goods, produces, and merchandises of all kinds, but especially opium, cultivated in or transited, re-exported through the Raj. And to that end, they organized amongst themselves and formed the Hong Kong and Shanghai Bank Corporation in Hong Kong, March 1865, and in Shanghai 1 month later. The founder, Thomas Sutherland, of the Peninsular and Oriental Steam Navigation Company, P&O Ned Lloyd, same company, y'all, wanted a bank operating on sound Scottish banking principles. Still, the original location of the bank was considered crucial, and the founders chose Wardley House in Hong Kong, since the construction was based on some of the best feng shui in colonial Hong Kong. The bank initially leased its premises for HK $500 a month in 1864. After raising a capital stock of HK $5 million, the bank commenced operations on March 1865. It opened a branch in Shanghai during April of that year and started issuing locally denominated banknotes in both the Crown Colony and Shanghai soon afterwards. The bank was incorporated in Hong Kong as the Hong Kong and Shanghai Banking Corporation by the Hong Kong and Shanghai Bank Ordinance numbers 2 and 5 of 1866, and a branch in Japan was also established in Yokohama in 1866. Shares of the bank were one of 13 securities initially traded on the Shanghai Stock Exchange and were traded on that exchange until the Japanese closed the exchange in 1941. The bank handled the first public loan in China in 1875, thereafter issuing most public loans. So I mentioned also yesterday that a bank by the name of Marine Midland, was purchased by the Hong Kong and Shanghai Bank Corporation. Now, understand that the main product that bank was established to facilitate was opium, because opium was in as long as it was British owned land, because Hong Kong was a British colony, just like British India, it could be traded. Now, more on that later. How you're going to see that all of these drugs and this, that, and other, this is nothing new. Okay, you already heard 1865. I mentioned the Opium Wars. This ain't new. Even some of the players are the same. I mean, so let's do this. Midland Bank, Marine Midland. Here we go. So Marine Midland Bank was a bank formerly headquartered in Buffalo, New York, with several hundred branches throughout the state of New York. In 1998, branches extended to Pennsylvania. It was acquired by HSBC in 1980 and changed its name to HSBC USA in 1999. As a result of several transactions since the turn of the millennium, much of what was once Marine Midland is now part of Key Bank, with the exception of downstate New York and Pennsylvania. So, why is all that important? Well, in 2012, HSBC was caught. This was during the Obama administration. They were caught laundering drug money. Okay. The DOJ slapped them with a deferred prosecution agreement, which was 5 years probation, and someone from the government was to monitor their transactions to ensure that they were adhering to following the law. And they also got slapped with a $1.9 billion fine. Well, there's a whistleblower who wrote a book called World Banking, World Fraud. His name is John Cruz. He even has audio that you can buy where while he was working at the bank and finding all of this stuff out and trying to, he was doing his part, turning in records, talking to his superiors. Nothing was being done. He was recording every phone conversation and every in-person conversation he had. So there's even a YouTube video of an interview that he did with Tragedy and Hope 101. More on all of that later. So the point of FinCEN's Financial Crimes Enforcement Network, they exist to stop the laundering that banks like HSBC does. That's why they exist. Now, HSBC and some other banks got caught again. BuzzFeed News aired that story. So did ICIJ, which is a consortium, an international consortium of journalists. They're right out of D.C. That's the headquarters. So they did it again. And again, a deferred prosecution agreement, which is phony probation and fines. This is what you're dealing with. So Best Evidence, a YouTube channel, a guy by the name of John Titus, did a documentary called All the Plenary's Men. And in that documentary, he highlights how these banks are protected internationally. Okay. So it's very interesting how they're lowering that threshold from $3,000 to $250,000. And then the banks also, they're doing that to monitor cryptocurrency. And then the banks have been given the green light by the Federal Reserve to literally have no cash in their vaults, forcing us to what? Focus on all things digital. And the reason why FinCEN even exists is because of the drug money laundering that HSBC got caught during Obama's administration. This is what you're dealing with. Okay, so I hope this makes sense. Sometimes I'll be scripted, sometimes I won't. Until next time.